Meeting is being recorded. Do we have Jerry Abrahams?
Here.
Tim Hodges? Kathy McKinnon?
Here.
George Perez? Franklin Perry? Sarah Sanders?
Here.
Gwendolyn Thames?
Okay, so it sounds like we do have a quorum.
Okay, we have one action item and several reports. The first action item is a resolution regarding the appointment of bond underwriters from the RFP. It was completed and good supporting detail was provided for the recommendation. I'll turn it over to Hazim.
Yes, good morning. So we have one action item that we would like to present and get approval from the board. So this is pertaining to the bond underwriters for our two bond programs. By statute, we are required to conduct and publish a RFP every 3 years. So this appointment will be effective for 3 years and for the calendar year of 2022, 23, and 24. So the last evaluation was done in 2018. In summary, we received 24 proposals, 2 of which were from new firms. With the assistance from our financial advisor, we review and evaluated them on a variety of items, including the firm's performances over the last engagement period, technical expertise, retail distribution, and credit capacity. As Sarah mentioned, our summary review findings, supporting documentation were provided to you. Based on our review for the Housing Mortgage Finance Program bonds, which is our master resolution, we are recommending that 5 firms to act as senior managers on a rotational basis and by program. 5 firms to act as co-senior manager, where each firm would be partnered with a senior manager on a rotational basis and by program. 8 firms were to act as co-managers, split by program, and 6 firms to act as selling group members. For the other bond program, the state-supported special obligation bonds, which carries the state credit, we are recommending 1 firm to act as a senior manager, 1 firm to act as a co-senior manager, 2 firms to act as co-managers, and finally 2 firms to act as selling group members. The name of the firms are in the resolution. I will now ask if any committee members have any questions in terms of what they saw, and I'm happy to address any comments, questions the committee may have.
Hazim, it's Jerry Abrahams. Can you just, I remember doing this last year. Can you just talk about the changes that you're proposing in the program versus what we have now, if any, in terms of firms coming out, firms coming in? And if you could also just comment on what we talked about last time in what percentage of the underwriting group represent minority firms?
Right. So let me just address the last questions first. So right now we have 14 members or 14 firms in the syndicate, 4 seniors and 10 co-managers. Within that 14 firms, or within the 14 firm in the syndicate, 3 firms they are designated as minority women business owned or a service disabled veteran. So what we are proposing now is we are increasing the number of senior manager from 4 to 5. And what we're also proposing is creating another special group, which is a predetermined co-senior group, where we would then assign firms that are designated as minority, women business, and service disabled as co-senior. And depending to the deal, we would then partner the firm referenced as the minority, women business, and service disabled veteran firm to work with the senior manager that is assigned to a particular deal. So that's one of the biggest change that we are making. So we believe, based on the responses that we receive, we look at each firm's capacity, and in terms of our intent to promote diversity and equity inclusion, we thought this is a good strategy to achieve that intent, and trying to diversify and provide an opportunity for firms to participate in our sale.
Commissioner Perez has his hand raised electronically.
Yes, I do.
Okay.
I don't know about eternity, but thank you. My question is similar to what I've asked in the past, since we're selecting or making the appointment of bond underwriters, is that our rules are clear that if any of them ends up being cited by a regulator because of violating laws that are meant to protect civil rights and protect low to moderate income people, that we're able to take them off the list. Did I lose you?
Yep. No. We hear you.
Okay. Or if they end up in a major regulatory issue with a regulator, because I could tell you, we did business with a company that at the same time we're voting for the company, I was hitting them with a fine for failure to supervise people. Now, I didn't bring that up because things happened. The company took the right steps and fixed it. But there are times when those companies decide not to do the right thing and fix the problem. So I just want to make sure that our procedures are clear, that in the event that you are cited for violating the different laws, whether it's HMDA, truthful lending, CRA, and by cited meaning that you've actually failed a test. And there's a rating that's given to those companies. Because this past legislative section, there was a bill that I helped kill, because for many reasons, even though conceptually I supported it, which was a bill that was introduced to say that we needed to do 100% of every company that did business in Connecticut of truthful lending, CRA, fair credit. And part of the reason I killed it is because they say every company, right? And legally, there are some companies that neither I or any other Connecticut regulator can touch because they are federally chartered, right? But the legislature has shown interest that we hold those companies much more accountable to complying with those laws. That's it. So is this the right time that we can make sure that those conditions exist? Or in the future, I don't expect any of those companies to run into those problems, but it could happen. Hello? Did I lose you?
No. I hear you, Commissioner. So the simple answer is yes, we do have every ability to suspend or to remove a firm that violates any of the things that you mentioned, if the board so desires during the engagement period. We made them aware during the request for proposal. We included that particular statement in the RFP itself, and the resolution. There is a section that does provide us that ability also, if it's unclear to any of the firms that gets appointed during this engagement.
Okay. Because especially under the current administration in Washington, I realize that could change. They're much more tougher than, if you think I'm tough, they're, the powers to be and the people they're appointing have a reputation of being really, really tough.
Right. So if you remember, like every single time when we issue a bond, we do need to seek bonding authority. So we do go back to the board and ask for approval. And during such time, we would introduce and identify the firms that we believe would work on the deal, or at least the team. And if in an event that during that time or such time that the board desires to make a change, then we can make the change at the time.
Yeah, but I also remember that we had a company like that, West Fargo. And part of the logic that you brought up was that we didn't have the ability to do it at that time. That we had to wait to make sure when we would issue our procedures that we take that into account. So I was double checking to make sure that in that rare event that were to happen in the future, that at least would not be an excuse. Now, whether the board wants to continue to do business with somebody who breaks a federal law or a state law, that's a different argument. But at least I don't want to have the excuse that, well, we can't do it because, you know, we don't have the right to do it under the current, you know, set of rules.
Understood.
Okay. Thank you.
Any other questions?
So Jerry, before I forget, I know one of your question also asked about in terms of the participant, did anything change? Like I mentioned, 2 firms are new that of that 24. So 22 are in fact firms that did respond at the last engagement or request for proposal.
I'm sorry, which 2 firms?
The new one.
Yeah.
If you look at the packet, it's identified. We did reference it like
Yeah. I didn't get my package till late. I had a problem with the confidential folder. Okay. Oh, Raymond James and UBS. Got it.
no. That's not new. You're saying new app applying, right? Didn't you ask? You said like
Yeah.
who applied? Yep. It's
So which of the 2 new ones?
Is Michelin and Rockfleet.
Oh, got it. Us as selling group members. Okay.
Azim, how does the transaction costs factor into the selection, or does it at all?
For our deal, it does not, for the most part, because it's driven mainly by the structure of the bonds. We utilize our quantitative consultant to identify how the bonds should be structured. Other states, they would, in effect, pay the firms additional expenses for managing and structuring the bonds. So on our for our type of the deals, is more about the bond itself. If we sell longer bonds, then we have to pay more expenses just because the more negotiation that has to occur.
So that's agreed upon up front. It's not something that they bid on.
It's more like it's more a consensus within the sector.
Okay.
So it's like that's the standardization in a way of what that applicable price is. So that's how it works.
Okay, thanks.
And Connecticut housing is always at the lower end of that particular price, believe me.
But if the question has to do with the actual takedowns that CHFA offers the underwriters, isn't that something that you dictate yourself, Hazim?
Yes. So what we do is we do have a price. We are very aggressive when it comes to the takedown for serial bonds based on the maturity. So it starts off at $2.50 per bond. It goes up to $3.75. Then it goes to $5. Then finally it goes to $6.25. We do know that for certain general revenue bond, depending to how complex it is, it can even be much more expensive than that. So for housing in general across the country, that's the typical scale. What is different, however, is whether or not we can push the takedown, like say for the $5, how long can we go, or the $3.75, how far into the curve can we extract that particular price?
Any more questions? With that, may I have a motion for the resolution?
I'll so move. Jerry Abrahams.
Second,
I'll second it, Kathy.
any further discussion? I guess we have a roll call vote.
Do we have Jerry Abrahams,
Aye.
Tim Hodges, Kathy McKinnon,
Aye.
George Perez,
Yes.
Franklin Perry, Sarah Sanders,
Aye.
Gwendolyn Thames, it's unanimous.
Okay, next on the
Sorry,
agenda.
you
is the
probably
series-
called my, I'm sorry, it's Tim Hodges. You probably called my name and I was on another call. So I vote yes as well.
Okay, it's unanimous.
Thank you. So now we'll be moving on to a series of reports, and Hazim's leading all of them. So I'll just turn it over to you, Hazim.
Yeah. So yeah, I'm on like a one-person crew today. Everyone like bail on me. Lorraine,
Yep.
can you log in on your screen? Because you
Yes, I don't know what's going on with my screen.
you have to enter the password. Like that's what we're
Yeah.
assuming is like.
Oh. Let me just see what's going on here. Sorry.
Okay. So while Lorraine is loading it up,
Sorry.
the first item on the report is regarding the 2021 Series E bond issue. Here with us today is Barbara Feldman and Joe Manito from Bank of America.
There. Okay, sorry.
So the summary is here. I would say when it comes to the 2021 E sale, there's a good day and there's a challenging day. So when we have a challenging day, it's always important to have a strong syndicate to weather the storm. So with that, Barbara, I'll hand it to you.
Thank you, Hazim, and good morning, everyone. I'm Barbara Feldman. I head up the housing group at Bank of America, and good morning, all. We are very appreciative of having had the opportunity to be lead on the deal. It was an interesting deal, not just because of the market, but because of the intricacies of the transaction itself. It had 5 series. It had something for everyone: non-AMT bonds, AMT bonds, taxable bonds, social bonds, sustainable bonds, you name it, we had it. It was brought to market during a week when there was an expected $11 billion in municipal offerings and 6 housing deals, which is a lot of housing for the market in 1 week. It went very well. It was priced on October the 13th, Wednesday. We had a retail audit period in the morning and accelerated in the second half of the day. And I'm going to turn it over to Joe to give you some of the marketing highlights. And hopefully you've had a chance to look at the pricing book. It's got much more detail than we'll give today. Take it away, Joe.
Great. Thank you, Barbara.
Joe, Sorry, Lorraine, can you turn the page? And then Joe, can you let Lorraine know which page that you want to focus on?
Sure. Keep going back. Go back to
Go back.
3. Yeah, I think if you'd stay on this page for a few seconds. I'm
Okay,
not going to necessarily speak to everything on it, but that's a good sort of placeholder for now.
Okay.
As Barbara was saying, Connecticut HFA had returned to the bond market the week of October 10th, which was a holiday shortened week. And we originally had targeted a 2-day order period beginning on Wednesday and then completing on Thursday. It's common for tax exempt deals to have 2-day order periods, with retail getting preference the first day, and then going into the institutional order period. We can leverage that book of business and try and sharpen the pricing and extract the full value from the institutions after having dialogue with them leading up to that formal pricing. So having a strong retail order book going into that portion of the pricing provides us leverage to really sort of maximize and optimize what we're able to achieve. As we were approaching the marketing period, we're continuing to experience low interest rates, but the market was starting to feel what we would characterize as heavier, with the tone changing from a seller's market to more of a buyer's market. The shortest maturities were still being well received, but longer buyers were starting to hold cash in anticipation of the Fed announcement coming up related to their asset purchase tapering beginning in November. We came to market with a $146 million transaction, as Barbara said, split between 5 different series. The first 2 were tax exempt bonds for over $65 million, which raised money for multifamily projects. The third series was a taxable bond for $20 million, also multifamily. And then the last 2 were single family. They were about $60 million split between tax exempt non-AMT and AMT. So as alluded to, there was something for everyone, and the deal had a lot of complexity in the structure. In addition, all the talk in Washington about tax law changes have made selling AMT bonds more complex because their future value could be diminished depending upon the tax changes. So to address that concern, we structured the AMT bonds as premium coupon bonds to try and attract incremental investors and to diversify the bond structure. During the retail order period, we received over 55 million of retail orders, which included 17 million of local Connecticut retail. So given that strong retail reception and the mounting pressure in the market, we collectively decided to accelerate that institutional pricing to the afternoon of the 13th. So in addition to the retail business, we saw an additional 208 million of institutional orders spread out among the 5 series. So overall, when you compare the gross number of orders to what we had to sell, you had 1.8 orders for every bond that you had that you were offering. And so, you know, on average, that looks wonderful. But as you've obviously heard before, averages can be deceiving. There were many bonds where we had multiple orders for each dollar that you had. So those bonds were oversubscribed. And then there were other bonds where we had no orders. When that happens, we need to obviously make decisions as to how to deal with those mismatches. So for the bonds where there was oversubscription, we were able to lower the yield by 5 basis points on many of the non-AMT bonds in 2032, 33, 46, 51, 56, and 61. So that was a significant amount of repricing to the better. For some of the shorter bonds, we were also able to lower, also non-AMT, their yields between 3 and 6 basis points. But for many of the AMT bonds, there were fewer orders, and there we adjusted the yields higher by 2 to 3 basis points for bonds in 22 and then 27 to 30. All in all, we underwrote bonds whereby the syndicate purchases those bonds without having bona fide orders behind them for $34.8 million, and that allowed us to lock in a firm price for CHFA. We were one of several deals that week which included New York City HDC had a $125 million taxable issue, and New York State HFA came with $46 million tax exempt issue. So these were both large, well-regarded housing issuers, which meant that there was other competing things in the market for folks to buy. But as a point of interest, New York State HFA chose not to accelerate their pricing, and so they wrapped up their pricing the following day. And where we had overlapping bonds, their prices, their yields were higher by 10 to 15 basis points. And so that acceleration and being prepared to do that and discussing it beforehand was very valuable, because we were able to pivot and catch a market which was starting to trail off. To kind of bring you current in the environment, Oregon, I think, was out just the other day marketing a transaction. And again, where there were overlapping bonds, there were 15 basis points higher in yield for some of those term bonds. And so some of this heaviness and weakness in the market is starting to translate into higher yields just a couple of weeks after your sale. If you can go to page or slide, I think it's 8. Well, let's see, keep flipping through, because your numbering is different from mine. Keep going. Next. Yeah, okay, let's leave it on this one for a second. So in the pricing book, there's a lot of data, but you can see from some of these slides the market volatility and the rate changes, but you can see rates have started to come back down from obviously the COVID spike, but now starting to to back up a little bit in here over the last few weeks. From the credit side, you can see that credit spiked when COVID hit, and now that's also coming back down. And then we have some other charts here which show the equities market has continued to increase, and chart on volatility. If you can go to the next page. This chart, oh, I'm sorry, keep going. We must have a different pagination. Next, down.
Oh, down, sorry.
That's okay. Next one. Perfect. Okay. Yep, that one. Okay. So on slide 9, you can see here, we typically show this kind of a band which shows where rates have been over the last 5 years, and then where they were sort of leading up to the transaction a year ago and currently. And you can see where we continue to be at the lower end of that 5-year historic range, but things have sort of gyrated a little bit in here. The next chart over shows the slope of the curve is starting to get a little bit steeper. And then we have some other, on the bottom, some other metrics which show some of the rates. If you look at the final one to the lower right-hand corner, you can see that one's got tax-exempt credit spreads. And the interesting thing there is, although the credit spreads have come down, you're that blue line at the bottom. You still get that AAA credit pricing, and that is a fairly significant advantage that you have in the market versus lower rated credits. Housing credits tend to be higher rated, but you guys are the Rolls-Royce out there of housing bonds. And then lastly, if you can scroll to the next slide. One more. Keep going, sorry. This is a good one here. Essentially what this one shows is this first chart here, projected municipal issuance. You can see that those bars are fairly high. And if you look at the chart all the way over on the right, you see projected Connecticut redemptions, which are significantly lower in the October, November, December ranges. And so what you're seeing is, from a technical standpoint, there's a lot more municipal issuance coming to market than there is reinvest monies falling in. And so what we're starting to see is that the technical side of the market is turning a little bit against the issuer and toward the buyer's advantage. The balance of the book has a variety of other charts in it. I think if you go to the next one, we'll probably show you, keep going. There was one chart. Yes, this one has some of the forward calendar, so you can see some of the other issuance that was in the market around that time. And then there are other charts in there which show things like who the various buyers are. I know that there's a lot of discussion about green, but what you'll likely see in the chart, which has the holdings or your major holders of Connecticut debt, you'll see a lot of the same sorts of names that have been holders of Connecticut bonds. And this is really a staple in many of those firms' portfolios, with Vanguard and Capital Group, TIAA and BlackRock all leading the way. And interestingly enough, although some of them do rebrand some of their portfolios as ESG, for the most part, we're not seeing, although there's a lot of talk about the groundswell of money flowing to ESG investments, we're not seeing a market difference between what was several years back and what we're seeing today. Many folks who've been buying housing bonds have known for many years that these are socially good investments, that they fulfill a need in society. And so they didn't need necessarily the moniker of social or sustainable to know that they were addressing those needs. And so with that, let me stop and open it up for any questions folks might have.
If nobody has a question.
George, is that your hand up?
Yeah.
Yes.
And my question is, and I realize that at some point, the credit rating doesn't play as a significant role, because it would be like saying somebody in a consumer transaction having an 850 credit score and somebody having an 800, right? They're going to get the same rate. The credit score is not going to matter. But when you mentioned Oregon and New York, compared to us, what is the credit rating from the rating agencies? Is it the same? Is it lower?
Usually they are kind of, I think that New York HFA is a AA credit. And I believe, and Barbara, correct me if I'm wrong, I believe Oregon is also a AA credit.
Yes, I think that's
And
correct.
compared to us, is that the same, better, worse?
Well, typically there are a couple of different gradations here. Some folks sell and get AAA by virtue of federally insured portfolios, and so they're selling Ginnie, Fannie, and Freddie. They wind up with a AAA, and because those securitized mortgages can be tracked easier, they get very good pricing. You guys also get AAA style pricing. Some other credits which are in the AA category can be 5 basis points higher in yield, typically in a good market. Sometimes, depending upon structure, they can price on top of, because with each municipal issuer, you have to take into account the tax situation in their state. And so it's not just credit rating, it's how much money how valuable is the in-state exemption. And for Connecticut HFA, it's very valuable, but it's also valuable in Oregon, and it's also very valuable in New York, which is another high tax jurisdiction. And so there are multiple factors that impact how much benefit you get in your pricing. For the most part, though, when you look at your transactions relative to the larger housing contingent out there, you tend to price at or better than transactions that come in that competing week.
And I would just add that spread for credit changes with market conditions. When there's, not enough housing bonds, that tends to go away or compress somewhat. When there are a lot of housing bonds, you may see a little more, value in the differential.
But I think the numbers show that the market's starting to think that the rates are going to go up. You can see that even in regular mortgages. The rates have gone up slightly. Still in record lows, but it's gone up slightly, and the market's starting to react to the inflation and the fear of the national debt. in my opinion.
Definitely.
Yeah, we're starting to see rates back up in here, no doubt.
Yeah, so I mean, I think it's a reflection of the current economic conditions and the fact that people are saying, at least in the short term, they don't expect it to get better. If not, it's going to get a little tougher, which compared to other times is still great numbers, but it's going to be higher than what we are used to for the last year or two.
And what we've been seeing is that the markets react to the headline news. And, you know, they seem very certain on one day what's happening and the next day they have a different view. So that turns into volatility in pricing.
Yeah, you know, the other thing I would point out is that I think your long bond in 2061 was at a 290. You know, and when you consider where inflation, at least right now, is, it's almost free money. So, you know, there's a lot of different characteristics that will impact pricing. When you see a general markets issuer selling debt, they'll sell a 5% coupon to yield in 30 years, maybe, you know, closer to 2%, right? But essentially, that bond, because it's a 5% coupon callable in 10 years, is likely not going to stay outstanding to the 11th year. Whereas your bond at a 290, if it stays outstanding, it doesn't go up in yield. The general markets bond is priced to its call date, and every date that it stays outstanding past its call date, its yield rises because it's now paying that 5% coupon, but it's only gotten the benefit of pricing to the call date. So, you know, there are a lot of things that make housing bonds look less valuable in the near term, but in the long term, they're actually quite valuable and quite well priced for the issuer.
I seem to recall in the pricing report that we did have one hedge fund buyer, and just one buyer, and but I was just curious why an opportunity fund or a hedge fund buyer would want to buy these bonds.
Well, obviously not knowing what their cash position is, sometimes they're buying these bonds relative to a spread in the treasury market, and they feel that that's attractive. Sometimes they're putting money to work for a variety of reasons. Occasionally they'll have multiple funds, and they'll have some pocket of money that they want to put into tax exempt investments. So, you know, we don't necessarily know what their motivations are, but they keep track of all of the different relationships in the market, and sometimes they will decide to buy tax exempt munis when they believe that they are cheap relative to taxables, and vice versa, they'll be a seller.
Right, but if you saw, but I guess still, okay, so if munis are cheap to treasuries or something, you'd still expect a somewhat risk tolerant buyer to find, you know, take more credit risk than these. I mean, I understand you don't know why they're buying it. I was just so curious about it.
Yeah, you know, again, they've got thousands of different motivations, but right now, you know, generally speaking, right now, the municipal market, they have ratios that they compare where our bonds trade to where treasuries trade. And right now, those ratios are relatively, from a historical standpoint, low, which means that you're getting a lot of value. But sometimes a hedge fund will look at that and have a particular axe in the market, and they'll think that that relationship is going to change. And so they'll buy it on some value proposition that they think that the relationship's going to change, and then they're going to sell that when that ratio gets even lower and trade back to treasury securities.
Right, but why buy then if you think the ratio is cheap, why buy a super high credit quality bond in a specialty state versus lots of other options out there if you're just looking to take the relationship?
Maybe some of their principals live in Connecticut. I mean, you know, there could be a lot of different reasons that they're buying.
We see that sometimes, Jerry, that the principals will come in and buy their safe bonds. It's very interesting when that happens.
Yeah. Yeah, I mean, I'm not questioning that the bonds weren't, clearly it was a, overall great execution. The other thing that I have, and I know that you guys we see this all the time, so this is not to single out the performance of you guys. And I know that you, Rich, in the bonds a little bit too, but yeah, still always, and Bob, maybe you could speak to this, is that, and again, I know this happens all the time, and not singling out the performance here by the underwriter on our bonds. But when you see the 5 and 6 times oversubscribed on the term bonds, you just seem to think that, wow, there's more pushing that could be done on execution. I know that bondholders aren't going to buy bonds if they think they're going to lose value right after they buy them, and I certainly understand that, but I don't know. It always just seems so disconcerting when you see that vast amount of oversubscription on your term bonds, given and then given where the adjustments that get made. And I know I also think you guys did take down some bonds. So overall, I think it was a great execution.
Yeah, I mean, oftentimes you'll see that in order to sort of maintain a yield curve, you can't necessarily get every last dollar of value out of a particular bond. I'm not saying that we didn't get every last dollar out, but if in fact you bump a bond 10 basis points, right, now all of a sudden that longer bond is lower in yield than the bond right in front of it, which may have no orders or may have only one-time subscription. Now all of a sudden everybody moves their order to that other one, and now you go from having 5 times oversubscription to being undersubscribed on that bond. And so there are all sorts of dynamics to try and maintain a yield curve, and also understanding the fact that you had New York City HTC, New York State HFA, and others in the market, all with competing bonds with similar sort of characteristics, plus or minus a few basis points. But yeah, I mean, oftentimes you'll see everybody flock to the max yield bond, and then the bond in front of it is undersubscribed, and you'll say, gee, that's kind of strange. Why didn't they want that bond for 5 basis points less? And the answer is, when you push on one too much, everybody leaves, and you run that risk. But we do diligence as underwriters where the pain threshold is. And so we will go to buyers during that, during the reprice, and say, you're not going to get your allocation. Where we need to move this, we need to move it. If we move at 5, is your order still good? If we move at 10, is your order still good? And sometimes buyers know, so as it relates to the 5 times oversubscription, sometimes buyers know that they want to get a particular allocation, but they don't actually want all the bonds that they put in for. And so they put in for performance so that they can come back around and say, hey, I got a crummy allocation. I wanted more, knowing that they really didn't want that much more. And so there's a lot of,
Optics.
Mind games, there's a lot of game theory that actually goes on during the pricing.
Yeah, I would imagine that's a lot of it.
Yeah, I mean, we actually have economists, including some who work for me, who believe, in an efficient market, we're supposed to try to get to just 1 times over. And I coach people that that's actually not a good idea, because when you are only 1 times over, people don't think there's going to be any liquidity in the secondary, and that's a problem. So,
but for someone like, and again, I am not suggesting that you guys, we see this all the time, right? It's not unusual. Like,
right.
I know, and we see it, and everybody sees it. Every good name sees it, unless you've got really a bond that's really struggling, right? But and I think that's a lot of people padding their orders and all the reasons that you mentioned. But you could. There's not going to be a lot of fear of liquidity in our bonds, right? And so, I'm not, the question is it, are we supposed to be more aggressive? But again, I don't think that this is unusual in any stretch of the imagination. All our deals look like this, and I know all the other high quality names experience the same thing.
And what we also see, Jared, just so that you appreciate, is that a lot of times in the last half hour of an order period, if the deal is going well, everybody is piling on, including people who already put in orders.
Yep.
Because they're just trying to pad their order to a point where they can get the amount of bonds that they think they're going to be allocated.
Or lever to get an allotment on another deal with the underwriter or what have you.
whatever, right? So,
Yeah, and
Thank you.
and to your point, Jerry, also I would point out that the following day in 56, and you were out in 61, HFA's 56 term bond was a 295. So, again, they're not a AAA credit, but they're a higher tax jurisdiction, and they are a strong AA credit. So, I mean, when you look at things relative to one another, they do tend to make some sense.
Yep. Okay, thank you.
You're welcome.
Okay. So with that, we're going to go to the next item on the agenda, which is on financial reports. So through September, I have a few notes here, not much different than what Allison reported last month. Reduction in new volume is contributing to the increase in the revenue variance. When we look at the bond interest expense, it is definitely in our favor due to the current rate environment. So CHFA has been taking advantage in refunding opportunities. On the admin side, we are 72,000 above what we spent last year when we exclude salaries and benefits. I'll be happy to answer any questions committee may have regarding the financial reports. If there is no question, I'll jump to the next report, which is on delinquency and forbearance. So for the month of September, CHFA purchased about 20 million of loans and securities for single family. Last year, during the same period, we purchased about 25 million. Our delinquency rate is less than 3%. For the down payment assistance, we continue to see high participation for our debt, or 89%. The average loan is currently about $14,000. And when we switch over to the forbearance, for single family forbearance, there's only about 249 borrowers currently in the program, compared to about 873 borrowers during the same time last year. For multifamily, the bond portfolio remains the same at 1.3 billion. Overall, the delinquency rate has dropped due to the payoff of the 333 State Street loan to less than 1%. And then for the multifamily forbearance, I'm here to report that beginning from next month, we will no longer have any project that is in the forbearance program that was approved by the board. I'm happy to answer any question or address any comments the board may have on the delinquency and forbearance report. Hearing none, I'm jumping to the next report, which is our quarterly investment and swap reports. In summary, the book value for our investment increased by 210 million. That's mostly due to mortgage receipt. We talked a lot about interest rate. So quarter over quarter, we did see a reduction in our yield from 193 to 1.73. On the swap, there has been no change. And that's due to the fact that CHFA has been issuing fixed rate bonds for 2021. I'll be happy to answer any question, comment regarding the quarterly investment and swap reports, if any. Hearing none, I will hand it back to Sarah for the approval of the minutes.
Thank you. So we need a motion to approve the minutes of the September 30th meeting. Can I have a motion?
Do we have Jerry Abrahams?
Yeah, I'm here.
Tim Hodges,
I think we have to have a motion and a second
Uh,
first,
need
and
a
then we can
motion.
do the
Oh.
roll call.
oh, okay, sorry.
Okay,
I'll move. It's Tim Hodges.
second.
I'll second Kathy.
Thank you, Kathy. And then no further discussion, and we'll do a roll call. Thank you, Lorraine.
Okay, do we have Jerry Abrahams,
Aye.
Tim Hodges,
Yes.
Kathy McKinnon,
Aye.
George Perez,
Yes.
Franklin Perry, Sarah Sanders,
Aye.
Glenda Thames. It's unanimous.
Very good. So we have just a few more minutes to the board meeting. I'll entertain a motion to adjourn. All in favor?
Aye.
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 See you.
Okay. Thank you so much.
You.
Thank you.